In today's session, we are going to look at International Accounting Standard 40. International Accounting Standard 40 talks of investment property. Now, what is an investment property? Investment property is land or building or part of a building or both. In other words, it's property held for use, to earn rentals or for capital appreciation or both. So in summary, investment property is land or building held to earn rentals or for capital appreciation or both. So in this case, we are talking of its land or a building, and the major purpose is to generate for us some rentals, or we keep it for the value to appreciate rather than for use by the entity or sale in the ordinary course of the business. If this property is used by the business entity, it becomes IAS 16, property, plant, and equipment. And if it is for sale in the ordinary course of business, it's put under IAS 2, inventories. So there must be a clear distinction between investment property, that is IAS 40, property, plant, and equipment, IAS 16, and IAS 2. For example, we can have a building that is used by the business entity. That is, maybe it's owner occupied. That becomes IAS 16. The same building, if it is rented to others, it is IAS 40. And if our job is to sell houses, it becomes IAS 2. So it must be very clear what investment property is. Investment property is land or building held to earn rentals or for capital appreciation or for both. That is rentals and capital appreciation when we refer to both. Now, what is the objective of IAS 40? The objective of IAS 40 is to prescribe the accounting treatment for assets held as investment property. That is, assets held for rental or for capital appreciation or both rental and capital appreciation, to know how to account for them in our books, in our financial statements. So what is the objective? Objective is to prescribe accounting treatment. Now, I've listed some of examples of investment property. For example, land held for long-term capital appreciation. So in this case, it is land and the purpose is for capital appreciation. So it meets one of those rentals or capital appreciation. In this case, it's capital appreciation. Number two, land held for undetermined future use. So in this case, land, we don't have currently what the land is meant for, but we just know that the land will be used in future. Building leased out under operating lease. Remember, in this case, although the lease standard, that is, previously there was IAS 17 leases, but it was revised to IFRS 16. But operating lease still remains. There is no transfer of risk and rewards for it to be under operating lease. Remember, in finance lease, risks and rewards incidental to ownership are transferred. In operating lease, risk and rewards incidental to ownership are not transferred. So in this case, if it's under operating lease, a building under operating lease, it means the risk and rewards are not transferred to the lessee. So it still becomes investment property because it will still be shown in the books of the lessor or the lessor. So vacant building held to be leased out under an operating lease. So in this case, just as I have explained the previous slide, the previous point, it's so long as it's an operating lease, it still qualifies to be investment property. Property that is being constructed or developed for future use as investment property. Now, how do we recognize investment property? Investment property is recognized in the statement of financial position as a non-current asset. To recognize is to put it into the balance sheet statement of financial position as a non-current asset. Now, investment property is recognized if two conditions are met. Point number one, probable that future economic benefits will flow to the business entity. And point number two, cost of the property can be measured reliably. So remember, these two conditions are the same as under IAS 40. Investment property is recognized when probable that future economic benefits will flow to the business entity. And number two, when the cost can be measured reliably. Now, note that investment property can be recognized in two ways. There are two ways of recognizing investment property. Now, when we are looking at recognition in this case, there is recognition for the first time, and there is a recognition for the second time, second year moving forward. Now, when we are recognizing investment property for the first time, it should be recognized at cost, following the principles of PPE. That is IAS 16. So they follow the same principles as IAS 16. So under initial recognition, investment property should be recognized at cost. Now, remember, cost includes purchase price, directly attributable costs of bringing the asset to its present location and condition, dismantling, restoration, and removing costs, and borrowing costs, if any. That is according to IAS 16. So the principles remain the same. Now, under subsequent recognition, that means recognition for the second time. You have initially recognized the property, and now maybe 1 year has elapsed. Now you want to subsequently recognize. The standard tells us we can use two methods, either what we call cost model or fair value model. Remember, in IAS 16, it's also the same. We can use cost model or revaluation model, which in this case, it's called fair value model. So the take-home point here is, under initial recognition, investment property should be recognized at cost. Under subsequent recognition, investment property should be recognized at either number one, cost, or number two, fair value model. You must be consistent in the method you use, because of a standard called IAS 8, which talks of accounting policies, changes in accounting estimates, and errors. So if you decide to use cost model, continuously use cost model. If you decide to use fair value model, continuously use fair value model. So once more, in initial recognition, investment property should be initially recognized at cost, following the principles of IAS 16. And IAS 16 clearly defines what cost is, and we have said components of cost includes purchase price, and you must remember to remove trade discount, if any, cost to bring an asset to its present location and condition, dismantling, restoration, and removing costs, and borrowing costs to be capitalized. Now, under subsequent recognition, just like under IAS 16, investment property should be, or IAS 40 allows us to use two models, either cost model or fair value model. Under cost model, investment property are recognized at cost less accumulated depreciation. Cost less accumulated depreciation, just like in IAS 16. Under fair value model, fair value is the amount for which property could be exchanged between two knowledgeable and willing parties in an arm's length transaction. In a layman's language, selling price minus selling costs. That gives you fair value, and it must be an arm's length transaction. Now, note that under fair value method, we value investment property at the end of each reporting date, reporting period. The revaluation results to either gains or losses. So we do our revaluation under fair value method at the end of every year. And I'm referring to an accounting year, not calendar year. So the revaluation results to either gains or losses, which should be accounted for in the P&L. Gains or losses, which should be accounted for in the financial statements through the P&L. What is the accounting treatment of investment property? For gains on revaluation, or when we use fair value method or model and we have a gain, you debit investment property. In other words, you debit asset and you credit income statement. Remember in IAS 16, when there was a revaluation surplus, we were debiting asset or PPE and crediting revaluation reserve. In this case, we don't do that. We debit investment property and we credit income statement. Remember, there is a gain on income statement. So this is taken to the income statement. You credit income statement. For losses on revaluation, you debit income statement and you credit investment property. You debit income statement and you credit investment property. This is same as under IAS 16, unless in IAS 16 there is a revaluation downwards for a property that was previously revalued upwards. That is when you debit revaluation surplus, you debit income statement, and you credit investment property. Otherwise, the accounting treatment of IAS 40 is you debit investment property and credit income statement in case of a gain. Remember, income statement is credited when there is an income gain. So under losses, you debit income statement and you credit investment property. Derecognition of investment property. What is to derecognize? To recognize is to remove an item from investment property. So when do we derecognize investment property? Number one, when the property is disposed, that is when it's sold out, or when the investment property is permanently withdrawn from use and no future economic benefits are expected. If you have stopped using it, either for rentals or for capital appreciation, and also if there is no future economic benefits from the property. The gains or loss on disposal should be calculated as the difference between the net disposable proceeds and the carrying amount of the assets, and should be recognized as income or expense in the income statements. Finally, how do we disclose? What do we disclose under investment property or under IAS 40? Number one, the movement in the period, maybe from property, plant, and equipment to investment property or to inventories. In other words, movement from IAS 16 to IAS 40 or even to IAS 2. So if there is any change, for example, if an item is held for sale in the ordinary course of the business, that is inventories. If an item is held as owner-occupied property, in that case, it is PPE. If it is held for rental or for capital appreciation, that is investment property. So if there is any change in this status, it should be reflected. Point number two, criteria for distinguishing PPE and investment property. How do we separate? How do we distinguish between IAS 40 and IAS 16? Whether fair value or cost model has been used, that is in the case of subsequent recognition. The method and significant assumptions applied in determining the fair value of investment property. What method, what assumptions did you have when you were calculating the fair value of investment property? And the extent to which the fair value of investment property is based on evaluation by a qualified independent valuer. So these are the 5 key points that must be disclosed when you are accounting for IAS 40 investment property. Now, there is an example that will enable us cover investment property. So we have an example with us. Selling a manufacturing company purchases a property for 1 million on 1st January 2020x1. So let's just have it as 2001 for its investment potential. So in this case, Selling has purchased a property for 1 million USD on 1st January 20x1 and for its investment potential. The land element of the property of the cost is believed to be 400,000. So out of the 1 million, 400,000 goes to land, and building is expected to have a useful life of 50 years. Now, land accounts for 400,000. That means building accounts for the balance of 600,000 to make it 1 million. And the building element is expected to have a useful life of 50 years. Now, that means a depreciation rate of 2% for the building. So at 31st December 20X1, that is at the end of this year. Remember, it was purchased on 1st January 20X1. Now, at 31st December 20X1, 1 year down the line, local property indices suggest that the fair value of the property has risen to 1.1 million. So required, show how the property would be presented in the financial statement as at 31st December 20X1 if selling adopts. Remember, there were two methods that could be used in subsequent recognition, either cost model or the fair value model. Either cost model or the fair value model. So let's see how to account for this through the income, through Excel sheet. So we have the same question with us. So selling, a manufacturing company purchases property for 1 million on 1st January 20X1 for its investment potential. The land element of the cost is believed to be 400,000, and building element is expected to have a useful life of 50 years. At 31st December 20X1, local property indices suggest that the fair value of property rises to 1.1 million. Required, show how the property would be presented in the financial statements as at 31st December 20X1 if selling adopts the cost model or the fair value model. So in our solution, remember, in subsequent recognition, we can either use cost model or fair value model. So let's start with the cost model. How do we account for the cost model? So the total value, the total cost of property, total costs of property, the total cost of the property was the total cost of the property was 1 million USD. And out of which land had a value of 400,000. And remember, property is land and building. And building had the balance. The balance is 1 million minus 400,000, which gives us 600,000. So that gives you a total value of that plus that, which adds up still to that 1 million. So I don't even need to show that. We know that the total is 1 million. Now we know that principally land is never depreciated, but building is depreciated. So the useful life of building is 50 years. 50 years. The useful life of building is 50 years. Now, we need to calculate depreciation for building. Depreciation for building. So what is the depreciation for building? We are assuming straight line method is used. So depreciation for building will be 600,000, which is the cost of the building, and we'll divide it by 50 years. So by 50 years, that will give us a value of, it will be 600,000 divided by 50 years. So it will give us a value of 12,000 depreciation per annum, per year. Now, what goes to the income statement in this case, and what goes to the balance sheet? So, or what goes to the P&L and what goes to the statement of financial position? So, under the statement of financial position, that is extract of statement of financial position, or let me start with the statement of P&L, statement of profit or loss, because that is a statement we first of all account for, we will have an expense. There will be an expense called depreciation. And the depreciation will be 12,000. So remember, depreciation is an expense. So the depreciation will be 12,000. So that's the only item we account for in this case under the cost model. And there is what we call statement of financial position. Statement of financial position. So we have our P and L, and we have our statement of financial position. Now, in our statement of financial position, there will be non-current assets, and we will have investment property, and we want to get the carrying amount. So we will show the cost, we will less accumulated depreciation, I can even put it here, accumulated depreciation, less accumulated depreciation, and then it gives us the carrying amount or the net book value, carrying amount. So the cost in this case is equals to 600,000. Accumulated depreciation is equals to 12,000 because it's only for 1 year. And the carrying amount is 600,000 minus the 12,000. So it gives us 588. However, this was investment property, but this was building. So that gives us land is never depreciated. So the value of land remains as 400,000. So the total will therefore be carrying amount of building plus that of land. So the total value becomes 988. So land and building, the total value becomes, so let me put it down here, land and building. The total value of land and building becomes 588 plus 400. So that gives you, so we are done with the cost model. So cost model, the accounting treatment is the same as under depreciation. So we are done with that cost model. So maybe let me just highlight the major items we need. And remember, we were in the cost model. So we were under the cost model. Alternatively, we can use what is called fair value model. Fair value model. So what do we do under the fair value model? So under the fair value model, remember the property is shown, the value is shown at fair value. So here under the statement of P and L, profit or loss, there is a gain of 1 million. There is a gain on that revaluation. And the gain, how do you get it? The fair value is 1.1 million. You can see here. You will take 1.1 million minus 1 million, which was the cost. 1 million. I hope I'm clear. 1 million, which was the cost. And in this case, we will have 1.1 million minus 1 million, which is the cost, to give you a gain of 100,000. Under fair value method, we don't depreciate investment property because the fair value is determined at the end of each year according to IAS 40. So there is no depreciation charged. No depreciation charged under fair value model or model. So I hope that's clear. Under the fair value method, because we are doing revaluation at the end of each year, there is no depreciation that is being charged in the fair value method. So I hope that is very clear. So that is a statement of P and L. Statement of P and L. Remember, we started with the cost model. Now we are in the fair value model. Fair value model. Now let's look at statement of financial position. Statement of financial position. Statement of financial position. Now in statement of financial position, under non-current assets, we show the investment property with its fair value. Fair value. We disclose the fair value of investment property, which is 1.1 million. In conclusion, what are we saying? Under fair value method, we calculate the fair value at the end of each year. We calculate the fair value at the end of each year. Fair value is computed at the end of each year. So that is under fair value method. Under the cost model, we have the cost and we deduct the depreciation. But remember, land is never depreciated. It is only building that is depreciated. So we only depreciate building. That we only depreciate building. So it's only building that is normally depreciated. So in summary, how do we recognize investment property? Investment property is recognized as an non-current asset in the statement of financial position. Investment property is recognized when it meets two conditions: probable that future economic benefits will flow to the business entity, and the cost can be measured reliably. How do we measure investment property? We can measure under initial recognition using the cost model, or under subsequent recognition, you have the option to either use cost model or fair value method. Under the cost model, you determine the cost of the investment property and you determine the accumulated depreciation, and you take cost less accumulated depreciation to give you the carrying amount, which goes to non-current assets. And then in the income statement, you show the depreciation per year, the depreciation for the year. Under the fair value method, in this case, we don't charge any depreciation because according to IAS 40, investment property, we calculate the fair value at the end of each accounting period. And that summary brings us to the end of this standard on investment property.